Welcome, traders, to After Hours at Traders Pulse for Friday, December 19th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at Traders Pulse, joined by no one here alone today for the last Friday before the week of Christmas. So it's fun to take a moment here to talk with all of you. After Hours is your go-to live stream focus on macro trends for retail traders. That's dollar, equity, and policy for the uninitiated. After Hours is brought to you today by Blue Sky, the best-in-class prop firm that offers same-day activation, daily payouts, and no max restrictions. But we'll tell you more about that later. For now, let's turn to what is going on in markets. All right, guys, it's been a choppy week in markets. We've seen this on Price Action Live, watching the NASDAQ, how it's been moving. But over the last couple of days, after the low here that we had in on the 17th, we've been rising since then. So let's go take a look at what, first of all, is happening with the dollar. That's always my go-to, always what I want to see first, because it lets me know, hey, what's going on with dollar liquidity, or at least the demand for the dollar. So we have the dollar here that is reached a peak, like after the bottom that we had on September 17th, when the Fed came out and said they were doing their first rate cut for this cycle, where we all expected the dollar to be falling down. Well, I expected the dollar to be falling down, and a number of other people, because we had the dollar falling ever since August 1st, right before the time where Powell decided, hey, we're going to, when he was at Jackson Hole, saying that, okay, yeah, maybe we're going to have to start rate cutting. We had a drop in the dollar since then. And then exactly at the rate cut on September 17th, boom, the dollar bottomed and it rose from there. And from that point on, we got like higher highs and higher lows all the way up to a peak here of late November 20th, November 21st. Where we had the Fed that telegraphed that they might not be cutting in December, which had an odd effect where the dollar fell after that. The dollar's falling. So it's like when they say they're going to cut, the dollar rises, and when they say they're not going to cut, the dollar is falling. Interesting dynamic there. So the dollar went up to the top of its range and it fell down to the low end of its range. This was what, 3 days ago. So on the 16th, it hit down to the bottom of its range over here, and now it's bouncing up still. So the idea is that we're still inside of this range that was created since the spring of last year. And the question is, are we going to now rise here? Is this a higher low from the lows from before? And we're going to rise up to 100 point, 8 on the DX futures, or are we going to roll over here at around 98, 85 and head lower? That's a big question, because the idea here is that when the dollar falls down, we can expect equities to rise, and vice versa for when it rises up, when the dollar rises up. So we'll see. If we're taking a look at equities, we have the S&P. That's been, with the high volatility, we have had these large swings of about, peak to trough here. We're dealing with a 6% swing, but we haven't, there's no circuit breaker days. There's no massive events. We just had tariff issues, and we've been just going sideways, basically. And now the S&P is sideways to up. We're at 68.90, and looks to be rising. Same thing, similarly with the NASDAQ, except with a little bit more weight to the downside, as might be expected because of Bitcoin's price, which is still lamenting below 87,000 here on Bitcoin futures. We have gold futures that's up massively. Are we at all-time highs or near all-time highs? Yeah, all-time highs here would be 44, let's call it 4444, and gold's at 43.69 and rising. So this is crazy bullish. If we have a drop in the dollar, you can imagine that the gold is going to rise pretty dramatically from there. Now, so that's what we've seen with the dollar and equities. Now, what's going on with policy here has been pretty interesting. We did have, after the last Fed presser where the Fed did telegraph that they would not be, that essentially be pausing. That's basically what Jerome Powell said last week, that essentially they think monetary policy is in a good place, which is code for don't expect a rate cut. And the odds for a rate cut just dropped dramatically. It was like 90% chances for a pause, 10% chances for a cut. And now, if we take a look at the, let me just pull that up real quick. We're seeing a 22% chance for a cut and a 77% chance, nearly 78% chance for a pause. Why is this significant? It's significant because as we're getting the drop in the markets, as we're getting more data, the chances for a rate cut is increasing, right? What the Fed has been saying is that because of the being in tension here, because thank you very much, Aventura. You're never alone when I'm here. I appreciate that very much. Because of the two mandates for the Federal Reserve being in tension, which is full employment and stable prices, because there was this issue with inflation, tariff inflation, remnant from the inflation from the COVID lockdowns, and then we had unemployment rising. We went from 4.2, I think the lowest in 40 years, and then now we're at 4.4 recently. So that's rising. Normally they would be cutting as unemployment goes up, but they should be hiking as inflation is still a concern, as they're above their 2% target. So not sure. So the idea here is that CPI came in, I believe it was at 2.7, lower than previously. And so the idea here is the market saying, hey, if we have less of an issue of inflation, then your mandate for cutting because of employment should still be there, right? We should be cutting. So the odds of that is increasing. If you believe they're going to cut, if you believe, like, hey, markets are going to drop and unemployment is going to rise and we're going to see fractures within the economy in that sense, that's what required stimulus, then you want to take the bet that interest rates will rise. And you can make, nearly 80 cents on the dollar here if you bet on the other end. So that's an interesting way of looking at things. But that's the state of what we're seeing right now. But as far as policy is concerned, we're also having the issue where in May, we're getting a new Fed chair, right? And we sort of want to front run policy on long term investing anyway, as to what is that going to mean, right? If we're going to have a Fed chair that's going to be doing the bidding of the Trump administration, does that mean we're cutting to zero come hell or high water? Hard to say, because the guy who was the runner, Kevin Hassett, I believe is his name, has been saying now, even as the odds of him being the Fed chair rose, that we can't be too quick to cut. Is it cautious? Is it uncertainty? Are they seeing things behind the scenes? We don't know. We know what's going on there. So this uncertainty that abounds. Now, the one thing that people have been talking a lot about is liquidity and positioning. Now, we did talk about this last week when we brought this up with Darius Dell, who had an interview, I believe, on Bloomberg TV, talking about the 6 criteria that he looks at 42 Macro for what moves markets. So that would be growth, inflation, monetary and fiscal policy, liquidity, and positioning. And so, obviously, growth and inflation, we've been talking about that. That's the economy. That's what's going on with the supply of money. We have policy. We talked a little bit about that, about the tension between Trump and the Federal Reserve and what they're going to decide to do and what their mandate requires. But then we have the issue of positioning and liquidity. So position is just how our market's positioned right now. What are institutional, non-institutional players doing, commercial, non-commercial, what's retail doing, what's the option market like, that sort of thing. And as far as that position is concerned, we did have an interesting thing this week, today, where we have, 1 second here. We had largest Opex ever, right? So this is a post from Spot Gamma who sums it up nicely. Largest Opex ever. At 9:30 a.m. Eastern Standard Time, we see 1.8 trillion delta notional of SPX expire. And at 4 p.m., another 500 billion of ETFs and single stocks expire. While calls outweigh puts, we don't, I believe it was a 3 to 1, we don't detect extreme imbalances in positioning, which could be relieved post Opex. You will likely see some 9 trillion figure in the news. That 9 trillion assumes every contract expiring is worth 100 shares of stock. This delta method is more reasonable in our opinion, as it uses delta to equate actual share notional value. What does that mean? If you're not inside of the option space, is that you can't just take the number. You can't just take the number of options that are out there and multiply that by the share value. You then have to take that number and multiply it again by the delta value. How much those options really are moving when a dollar of the stock is moving on the underlying. And so 9 trillion wasn't the number that was floating around. It was on 7 trillion. The number was floating around. That's a lot. Right, 7 trillion is a lot, and if you expect that, you can expect a massive move one way or another into the market, and that's not what we got. We did get a 1.44% move in the Nasdaq today, but that's not some crazy thing. We've had that over the last few days. And this is what they were saying here, that even though it's 9 trillion, 7 trillion in notional value, the delta notional will be about 1.8 trillion plus, and 500 billion at the close, plus, even though calls outweigh puts, it's not extreme imbalances, which is what we saw today. What we saw today is the markets moved. If you take a look at the Nasdaq, we didn't see a crazy move today at the end, right? We saw a rise of about call it 1.25 up, which is to be expected. Once those options are gone, you can expect a drift up inside of markets if there's no negative catalyst. We expect that. And even from the lows, we have a rise here of 2.76%, which is a lot for equities, but not like some crazy amount. And so it's, so what's to be expected. So now for the next coming weeks, what we're looking for is that we do have, even though we had weekly Opex, and today we do have the quarterly and yearly options that expire at the end of the month. So we'll see what December 26th looks like. But if, again, there's no catalyst there, I would not be surprised to see, honestly, I wouldn't be surprised to see NASDAQ at 26,300. Like, that to me is not a crazy look. And even Spot Gamma was talking about seeing the S&P at 7,000. This is not crazy. we've been there before, near there several times. No reason why we can't go to new all-time highs, especially as we're headed into the new year. So that's positioning. A bunch of positioning happened down because of option space and how big that is, especially when it comes to zero DTEs. But what I wanted to talk about today is liquidity. Liquidity comes in various different flavors. People talk about it in terms of liquidity when they're trading. They'll talk about liquidity positions where orders placed on the book. If you're talking about asset liquidity just in general, you're talking about how much volume is being traded regularly on that asset. How much can you trade that asset without moving the price drastically? That sort of liquidity. But the liquidity that's on everyone's lips because of the popularity of liquidity cycles with Bitcoin is the flow of dollars throughout the financial system. Are the dollars flowing in such a way as it causes a propensity for lending and borrowing? Is credit being created? Is debt being created? And if you don't have that, well, then you can have asset price inflation because there's no additional new dollars that are being created in order to do this. So I thought it'd be interesting there was a video that came out this week from David Lin interviewing Michael Howell, who goes on to talk quite a bit about this. And I thought it might be nice to have, hey, right before Christmas, let's get our little homework in and understand a little bit more about what global dollar liquidity is if we don't already know. All right. Oops, sorry, I have the wrong screen. All right, sorry, forgive me. It does not look like this is right. Let's stop sharing you and do it again. Oh, I see. 1 second here, folks. There, that's better. All right. All right, forgive me here. The first one's at 144. So we're going to hear here Michael Howell from Cross-Border Capital, or previously Cross-Border Capital, talking about global liquidity. We're going to jump through this video and watch a few of the parts.
So we go. We look at global liquidity. Global liquidity is what has been driving asset markets for certainly much of the last 3 or 4 years, but arguably a long time before that too. Assets are very sensitive to liquidity. Just look at the behavior of Bitcoin for one particular example. In terms of why we think that liquidity is going down or peaking, is broadly because of two things. One is that central banks generally, and I know the Fed has changed a little bit in the last 2 days, but generally central banks are beginning to slow their liquidity injections into markets. But set against that, what you've got is a strong real economy. You've got something called the debt maturity wall, which is upcoming, which is basically funding a lot of debt that was termed out during the COVID crisis, and that's coming back to haunt markets. And the third thing is we know that fiscal spend is racing ahead, and that somehow has got to be funded. So in other words, there's not enough money around. And if you take the thesis that all money that is anywhere must be somewhere, if it's in the real economy, it's not in financial markets. And that really is the problem.
I just want to go back to the statement that you made, which is that central banks are halting liquidity injections. So we've got the Federal Reserve of the U.S. that's going to inject more liquidity. The Bank of England, where you're based, is about to cut rates, I believe. The Bank of Canada, where I'm based, is holding rates steady. The Bank of Japan is hiking rates. So there's policy divergence all around the world. So how are you getting that information? What are you basing that on?
Well, the first thing is that we're tracking the movements of liquidity from central banks. So we're looking at the amount of liquidity they put into the system. You're absolutely right to say the Federal Reserve has actually changed to some extent in the last couple of days. The question is, has it changed enough? The key point is that over the preceding 3 to 4 months, the Federal Reserve actually took a lot of liquidity or oversaw the extraction of a lot of liquidity from US financial markets, which is largely why you've seen this volatile move through the indexes and why Bitcoin has basically fallen back. So that's the US story. Eurozone, the basic prediction is that rates will be on an incline now. There's more likely to be tightening in the Eurozone. If you look at Japan, they're signaling the same thing. And if you look at China, rates are basically beginning to edge up. So I think on all these counts, what you've got is a backdrop where we may be near the peak in the liquidity cycle. We're not saying that liquidity is falling strongly yet, but we're saying that this is a prospect for 2026.
Why, can you just maybe at a high level to explain the theory behind why global liquidity moves in cycles to begin with?
Yeah, it moves.
This is a great part over here where they explain if you don't know why global liquidity even has a cycle, the next two parts are fantastic.
Cycles really because I guess for two reasons. I mean, one is that it's feeding. One is you've got central banks that are effectively injecting a lot of liquidity into the system at different times. They may have objectives such as stimulating employment growth. They may have other objectives such as trying to rein in inflation. You've got a real economy which is using that liquidity. And on top of that, you've got debt which needs to be refinanced. What we're looking at here is a cycle that is around 6 years, actually 5 to 6 years, an average of 65 months. It goes back all the way here to the mid-1960s. That cycle is very well established. You can see if you cast your eye towards 2022-23 that the cycle basically bottomed almost exactly on the point that the sine wave, the dotted red line, was indicating. We've now been in a bull market for liquidity and asset markets for about 3 years. We're coming close to a prospective inflection point. Why is it 6.5 years? Or sorry, why is it 5 to 6 years? The reason probably is that this is a debt refi cycle fundamentally. Liquidity is in the system to refinance debt. Financial markets globally have got so much debt. Most of the transactions that go through financial markets today are debt refinancing transactions. So this is a refi cycle. And the average maturity of global debt is, lo and behold, about 5 to 6 years. So it all seems to dovetail quite well.
That is an extremely important part to remember there, that the duration of the cycle has to do with the debt maturity. So the idea is that as the debt is being refinanced, that period of refinancing, that 1 year period or whatever it is of refinancing, actually it could be more than that, it could be 18 months or more, that drains liquidity from the system, right? Because that there's a seeking of capital, and there's not the transactions that are happening are not happening in order to boost markets or to chase bubbles or anything like that. Whereas afterwards, after the debt has matured, there's this runway, there's this extra capital that's there, this new credit that's been created, released, that can then go and chase whatever it needs to chase. And because the debt, generally speaking, it was about 5 or 6 years that people were taking that debt out for, or rather, it could take about a year and a half for everyone to finish refinancing their debt. You get this ebb and flow with these cycles. And so, yeah, we did see a bottom of the cycle in 2022, 2023, which launched up. Bitcoin's been up significantly from then. Equities up very much from then, and we've been a bubble since then. But the question is here that he brought up is, hey, have we peaked? Right, we peaked now. We're right around the peak of that cycle, where we'd be in that 65-month period, and what happens next could be a pretty significant downdraft. Now, before we continue, I just want to have a quick word from our sponsor.
Looking for a prop firm that actually plays nice with automation? Meet Blue Sky, built for serious traders. And with Traders Post, it just clicks. You connect Blue Sky inside Traders Post, route your TradingView signals to paper or funded accounts, and let it auto-manage entries, stops, and targets. You control risk per trade, filter by session and symbol, and pause or resume with a single switch. Every fill is easy to review in one dashboard. Funded accounts can request payouts daily with launch plans starting at $49. Get funded with Blue Sky. Execute with Traders Post. Apply today at bluesky.pro, BLUSKY.pro, and plug in your edge. Trading involves risk. Use proper risk management.
Excellent. Welcome back here. All right. So the next part I want to play from this video. Actually, before we do that, I do want to let me just switch quickly here to something that Jeff Snyder from Eurodollar University was saying. I thought it was pretty interesting too, and I just want to be able to pull that up. Okay. So, because there's two camps here. There's the camp of people who think, hey, we are, inflation is coming back roaring, and that we have to prepare for that, expect higher bond yields and stagnant to lower equities, and other people who are inside of the deflation camp, which is, again, equities down, but bonds up. That's going to be a flight for yield. So I like to see the other side of it, because we're just hearing from Michael Howell, who thinks who's on the side of inflation, and I want to see what we have here for the people who are on the side of deflation. One moment. All right. Okay, so this is a post from Jeff Snyder, who says, this is from earlier today. So Bank of England voted yesterday to cut its rate policy. Let me just zoom that in. Bank of England voted yesterday to cut its policy rate, then quickly said that that might be the last one. So BOE cut, and they telegraphed, just like the Fed, that it might be their last one. This is the latest in central bank chic to announce an end to the global rate cutting. ECB has done it. RBA did it. So that's Australia. ECB is the European Union. And Kansas City Jeff at the Fed wants to as well. Problem is, central bankers are always wrong. One reason why is their deep institutional bias towards inflation. They see it around every corner, even when evidence is non-existent, or, as now, contradictory. Doesn't matter. Inflation is the great risk of our times. Meanwhile, reality conclusively shows that beverage isn't actually a risk. It is a reality. Jobs are being lost all over the world, while officials say they're done cutting rates because the economy is in a good place. The data plus markets show exactly the opposite on both counts. Inflation isn't a threat. Unemployment is already jumping. US just posted a big rise, and so did UK. The higher the unemployment rate goes, the louder they get shouting about inflation risk. And that's why Pringles always wins, unexpectedly, of course. So he's making the, if you read between the lines of what he's saying here, he's saying, one, well, just to mention the beverage curve over here, when he's talking about the beverage curve, he's talking about the relationship between unemployment and job openings. So the idea here of the, well, let me just pull it up, of the beverage curve is that as you have job openings on job openings on the y-axis, and you have unemployment ratio on the x-axis, and then so the more jobs there are, the lower the unemployment rate, and vice versa for the other side. And so if this is flatter, if this curve is flatter, so this is a healthy curve. If it's flat, then that means that not only is there pressures where the unemployment rate is ticking up higher, even though more people are being released within the job market, there's not enough jobs for everyone to be able to get. So that is a recessionary signal. But he's talking about here that, but the Fed Jeff Snyder often talks about the idea that the Fed is making policy decisions on models that are not true. And so they're saying that the economy is in a good place, and when it's not. They're saying that the outlook in future is bad for inflation, where Jeff Snyder is saying, no, the risk is actually deflation. And that we're seeing this happening around the edges where there's problems with this, and that what we actually might get is surprise cuts once the bottom falls out, and we get a bunch of huge unemployment spike. We went from 4.2 to 4.4, but what if we go from 4.4 to 4.7 all of a sudden? That would be some giant rise, or this massive revisions that come in the past, or some debt pyramid somewhere gets toppled because there's a problem with deflation and there's not enough dollars to go around. So he's sort of making the case here buy bonds because you can expect yields to go down pretty quickly. All right, so that's the other side. I want to go back to what was being said here from Michael Howell. Let me pull that back up. And the next part I wanted to show is the stimulus. So when we're talking about money being injected within the economy, liquidity, not all liquidity is made the same. Even though money gets injected it might not be injected in such a way that it flows to assets, causing them to go up. It might go to the economy. It might go somewhere else. It might go to pay off debt, and then it gets destroyed. So not all liquidity is the same. So this is a very important distinction. Let's hear it from the horse's mouth.
This is looking at the US and the US Fed and US Treasury stimulus liquidity injections into the US system. And what this is basically showing is the amount of liquidity or liquidity equivalent that goes into the market. The red area of that is conventional QE. So that's basically the Federal Reserve buying coupon securities in the market. The orange is what we slightly flippantly call not QE. So it was not headline QE. It was actually occurring during a time when they were engaged largely in what they called quantitative tightening, although they didn't really do that. This was backdoor stimulus, if you like, a Sula Tabla sort of liquidity.
A quick thank you to you guys, Ventura and Mikey Davis. We do this for you guys. We do it for everyone. We want people to know more about this. So Watch Tom is like getting a free college level classes every week. Thank you very much. It's a lot of fun. And yes, if you don't catch it live, replay gang it is. Yeah, I mean, I do the same. I watch it to hear back what was said so that we can do better next time. Thank you so much for that, guys.
Liquidity impulse. Things like the reverse repo facility was pared down, Treasury General account, all these sort of phenomenon. A bit wonkish, but that shows liquidity going into the system. And then you've got the black area, which is really what the Treasury has been doing, funding a lot of its expenditure through Treasury bills. And what you can see is as the cycle has evolved, there's clearly been a cycle for sure, but the black area, which is Treasury QE, is dominating proceedings in 2026. So the Fed is stepping back, the Treasury is stepping forward. It's a transition from Fed QE to Treasury QE that underscores a much stronger economy. And what you can see in the little window that we put in that chart is the black line on that sort of shadow outline, the orange outline of this this bigger cycle. The black line is the change in the US PMI index, lagged by around 9 months. So what you can see there is how that relates to the cycle in liquidity. So what that's telling us is that 2026 should be a good year for the economy. And that maybe is exactly what the administration wants, given the fact that you've got midterms upcoming next year.
A good year for the economy, but not necessarily a good year for the markets, given liquidity conditions, right?
Absolutely right. So the corollary of that is what you may be seeing is a pickup in inflation. And if you look at the next slide, now this is
okay. So before we get there, just to point it out here. So what we see there in black is Treasury QE, right? So that's fiscal policy. That's what the administration does. And they might not be putting money, or the money that they're pumping into or outside of the Treasury general account might not be going to assets. It might be going to the economy in order to get more jobs and more money into people's hands. Well, if you get more money into people's hands, we saw what that did during lockdowns. You get money into people's hands, they spend it, and that's inflationary. This is a story I always tell people when they ask, why isn't all money printed the same? Because if I print $1 billion and I give you $1 billion and all you do is keep it inside of your basement, it makes no difference. It doesn't affect anything at all within the economy around you. If you take those dollars and all you're buying with those dollars are stock market and assets and financial market assets, only those assets will go up in value. right? Because in order to extract that extra money for when you bought it and it went up in price, only other people who have that asset can ever extract that value. So it gets stuck within the financial markets. But if you take that $1 billion that was given to you and you spend that within the economy around you, you will quickly see that prices around you will start to rise because people go, hey, there are more dollars floating around. There are more dollars out here. And if there's more dollars out here, I should raise my prices because there's more, in a sense, demand. The dollars are there, and so they can command a higher price. That's how it is. If more money shows up, people raise their prices. That's why college tuitions are super high, because it's being subsidized by the government, and so there's more dollars than there would otherwise be, and so prices go up. If that was not there, the prices would go down. And so here, the QE is happening, but the quantitative easing that's happening, the injection of liquidity, might not be going into asset markets, it might be going into the economy. Whereas the QE line, the red line, which is the quantitative easing we've been used to since the global financial crisis, QE1, QE2, QE3, QE infinity, that is super low, lower than it's ever been almost. And so it's not showing up in asset prices in exactly the same way. I mean, we are still near all-time highs in the indices, but we're not doing that whole run up like we saw in after COVID. And then finally, the not QE, that is liquidity when it comes to the bond market, when it comes to the repo markets, when it comes to the finance and the overnight financing that entities need to do in order to avoid volatility shocks or cascading system failure. Because of the debt chain. So there's different types of QEs that are out there. And Michael Howell is making the call that because we are focusing on the Treasury QE, that we might have inflation coming down the pike. All right, the last part I want to show here, it's a very great interview. You should definitely go check it out. I've watched this multiple times, 48 minutes long, but I'll watch everything that Michael Howell has to say. There's tons of slides in here. It's super, super useful. But there's only one thing I want to know here, this last part, which is, of course, his outlook for 2026, specifically as it relates to gold, silver, and Bitcoin. So let's see what he has to say.
Will AI take my job?
1 second here. Let's get past this ad.
Okay, so we've talked about asset allocation. We've talked about the potential magnitude of the S&P 500 move. What about gold and silver? Have we applied similar cycles to precious metals? I bring them up because unprecedented moves have been occurring for both of these metals in the entire precious metal space. And people are wondering, first of all, what this signals for global economic growth, but secondly, where those assets are in their respective cycles, Michael.
Okay, let me have a bash at that. I mean, basically what you've got to think about, these are monetary inflation hedges, okay, in the long term. Look back over the last 25 years, what's happened to federal debt?
Monetary inflation hedges are hedges because of what the central banks do and financial markets and asset prices.
Federal debt has gone up 10 times, okay, tenfold. I mean, that's an eye-wateringly large amount of increase in 25 years. How much has the gold price gone up? Gold price has gone up basically at least 12 times over that period. It's more than matched the increase in federal debt, and that's what you'd expect because there's monetization going on. How much has the S&P gone up? Under 5 times. So gold has been a fantastic asset. Could you have timed that? You probably could have timed that with, and got even better returns, but you didn't need to. You just need to hold gold. And that's what I would say looking at the medium term. Any weakness in gold, silver, precious metals, Bitcoin, buy on weakness, okay? What do I mean by that? Because you've got to be explicit. I would say if you're 20% below the trend line, I would be snapping it up because I think these assets are going up medium term. That's the fact because we've got more debt. More debt. Debt is riddling this financial system, but it keeps going up. Governments are spending. They're issuing debt. Debt means you need liquidity, and if you get liquidity following debt, that is monetary inflation. You need monetary inflation hedges because basically central banks, policymakers are devaluing paper money. So you need these hedges. Last point on this is let's think about China. What is China doing? China has a real estate problem, a big real estate problem. Japan had a real estate problem back in the late 1980s, early 1990s. The US had a real estate problem around the time of the GFC. How have those two economies got out of their real estate problems? How have they basically managed to inflate collateral in these markets? By printing money. China's got a bigger problem. What has China got to do? It's got to inflate massively, and it's got to try and devalue the yuan. And that is going on. How do you check that? Don't look at the yuan US dollar cross rate. Look at the yuan gold price. The yuan gold price is going up. It's going up, number one, because they're printing money. It's going up, number two, because the Chinese central bank is buying gold. And that is going to go a long way.
Look, going back to the economy and
there we go. I mean, so many good things in there, but I'll leave you guys to watch that video on your own. Absolute madness from Michael Howell on the David Lynn channel. So yeah, he's making a claim there. The thing I find interesting there is that he mentions Bitcoin as being one of these inflationary hedges, which is interesting because we have gold going up, we have silver going up even more, it seems, but we don't have Bitcoin going up. Or is it about to? Has Bitcoin bottomed and we're about to see a skyrocketing of Bitcoin 100% up from here over the next couple, 45 days? Someone in my chat said. Could be interesting. Want to buy calls? Want to get polymarket bets and Kalshi bets to the outside of Bitcoin? I might be taking a look at that this weekend. It'd be a pretty good Christmas and New Year's. All right, folks, that's it for today's After Hours. Thank you so much for watching and listening. That's what we do here at Traders Pulse. We create all kinds of content in order to be of use to you in your financial journey. We don't provide financial advice. You have to do your own research, but it's nice to have somebody else in your corner who's trying to let you know about things that are happening so you can spend time doing what you do best, your job, your work, your trading. We're going to be back, I believe, on Tuesday for Price Action Live. We were going to take the week off, but let's see if we can actually do it. Turns out we're all junkies for trading here, and I'd love to get my brother and Peter Hartman from the marketing team over to try his first prop firm trading. So that should be on Tuesday at 9:30 a.m. Eastern Standard Time with hopefully very calm waters that he can jump into so he doesn't pass his eval accounts way too quickly and make me feel inadequate. Wish you guys a very merry holiday season, and we'll be back next week. Thank you very much. And as always, happy trading.